Yes, sir. Hi, very good afternoon to you. This is Kotak Mutual Funds analysis on the interim budget. This budget balances need of an election-bound government along with an economy which wants to grow faster but in a more inclusive manner. This budget has provided relief and incentive for farmers, for middle class taxpayers, and for entrepreneurs. For farmers, for the first time, a universal basic income has been introduced, whereby about 12 crore families will receive 6,000 rupees a year. The scheme has been implemented with effect from 1st December 2018. It will entail 20,000 crore outflow this year and 75,000 crore outflow next year. For the middle class taxpayers, budget has focused on giving rebate for income up to 5 lakh rupee. It has also taken care of notional rent which you had on second self-occupied property. It has also provided for capital gains exemption if you sell a property and invest into more than one houses. Thereby, government has tried to put more money in the pockets of middle class tax earners. The third thing which government is doing is to encourage entrepreneurship by simplifying income tax process. The returns are filed online. Now the assessment and scrutiny will happen online over a period of time. The returns will be disposed of as quickly as possible on filing and refunds will be issued simultaneously. So the idea is to keep filing of income tax in as digital manner as possible so that there is improvement in ease of doing business. While providing all this support, the focus of this budget is to boost consumption. Last few years, India has pursued a policy of tight liquidity, high real interest rates to contain inflation, and successful inflation has come down from double digit to lower single digit. Now, the government is focusing to support growth. That growth is coming through boost to the consumption. Overall, if we see the budget, it has few positives. One, this budget has continued to maintain the path of fiscal prudence. There was a time between early 2000 where our combined fiscal deficit between central and state was averaging 10%. Today it has come down to 6%, 3.4% at center level, 2.6% at state level, and of course we need to bring it further down. The government's borrowing program, which takes large portion of deposit growth in banking system, has consistently fallen down. It was about 60% in 2011-12. It has now come down to about 33% in 2019-20. So as banks have ability to give more money to private investors, private borrowers, to that extent investments can revive. The good part about disruptive reforms like GST demonetization is improvement in tax to GDP ratio. Slowly we have started moving from 10% tax to GDP ratio to just below 12%. This improvement in tax to GDP ratio gives more money in the pockets of government to build infrastructure, to provide universal basic income to farmers, and more importantly, the burden of taxation is distributed equally among all taxpayers, whereas in the past, salaried taxpayers had been paying much fairer share of their tax burden compared to, let's say, businessmen. The budget is reasonably well balanced between the need for financial inclusion by providing support and subsidy to the poor and needy, at the same time giving boost to the consumption which will accelerate economic growth. The direct tax growth numbers in the budget has been reasonably well achieved. The indirect tax growth, the budgeted estimates have been little bit higher than the actual numbers. This has primarily happened as many items on which GST rates were at 28% plus have started falling and been moved into 18%, 12%, and 5% category. Hopefully, the new government will introduce invoice matching that will substantially reduce the leakages which might be happening on the GST right now, and that will result into acceleration in GST collections, and whereby the actual GST numbers will be meeting budgetary expectations. The budget has also provided about 80,000 crore for divestment next year. Certainly, government has far more assets, and if it pursues path of strategic divestment, then certainly this divestment numbers can be achieved. Today, divestment numbers are achieved by one PSU buying another PSU company. Tomorrow, we should aim for achieving divestment by selling one PSU company to the private players who can then create value out of it. Non-tax receipts includes income or dividend from RBI and other public sector companies, and hopefully those numbers are in line with the actual numbers, and that should be achieved without too much of a problem. At 3.4% fiscal deficit to GDP, the deficit looks reasonable, the budget looks balanced. However, part of this balance has been achieved as this being an interim vote on account. There has been no additional provision for capital expenditure. The capital expenditure growth is muted at 6%. In the new budget, new government will have to spend more money on capex, and to that extent, they'll have to raise resources so that fiscal deficit remains at 3.4%. More importantly, beyond budget now, markets will be looking forward to other events. For the debt market, one immediate event will be credit policy by Reserve Bank of India. Market will be legitimately expecting some amount of rate cut or direction towards lower rate by RBI, keeping in mind that inflation is low and the fiscal numbers looks reasonably poised. We believe 10-year government security, which is trading at about 7.35% on new 10-year, has potential to come down if RBI gives glide path towards lower rates or it cuts policy rates in the next credit policy meeting. On the equity market side, market of course will look at credit policy by RBI, but their focus will be on two more events. One is the business momentum in Jan to March quarter, how businesses shapes up. This is the busy season credit policy. This is the busy season quarter, and 30-35% of profit growth comes from this particular quarter. So markets will be keenly watching how companies' sales are moving up, how IIP numbers are moving up, and what kind of profitability growth can come in March 19 quarter over December 18 or March 18 quarter. The GST collections in January should be on the positive side, as indicated that it has crossed 100,000 crore. If that trend is maintained, then equity market will be supportive. The second big event market will look forward is the budget. Clearly, the second big event which market will be look forward is clearly election in May 2019. With budget behind, market's focus will be on the political uncertainty. Today, market is pricing in a stable government which will focus on growth, which will change India's GDP growth orbit to higher level, and that is what is priced by the market. If the election results are in line with the expectations of the market, market will be supported. And since 2018 was a year where there was not much return to be made in equity market, 2019 hopefully will compensate for that with good election and with good government. In case market gets a shock of a coalition government or a government which is not committed to economic reforms, then of course there could be corrections in the market, and 2019 could be as bad as 2018. Our feeling is that election results matter on the day of election. In 2004, markets were down because they got a shocker result. But post that, we had seen one of the biggest bull run in the lifetime as the work done by previous government and work done by new government resulted into economy growing at a faster pace. In 2009, markets went up when it got a surprise result as the government came back with higher number of seats. But post that returns were muted as the economic growth could not be maintained. In 2013-14, again there was another variety. Market started moving up from September 2013 at 18,000 level, and by May 2014 had reached to 28,000 level. This journey in anticipation of a stable government gave more reward to the investors, and post 2014 result till 2019 beginning, markets have given muted return. So effectively one has to take a call on fundamentals. The results will swing markets on the results day, but thereafter it is the fundamentals which take over. We believe a lot of good work done over the years has supported Indian economy to reach a level where GDP growth can accelerate from current levels. We have maintained a tight monetary policy and high real interest rates to control inflation. Now inflation is well below mid single digits. This gives room to RBI to improve liquidity, cut real interest rates, and that will be supportive for growth. The second thing is institutional reforms like insolvency. Earlier, creditors were always at the mercy of borrowers or debtors. Payable when able was the norm. But now with IBC, we have seen big promoters losing their companies if they default to the lenders, and lenders have become powerful. One of the SBI executive did mention some time back that now borrowers are coming and saying, Madam, please don't take us to IBC. We'll be happy to make the repayment. Third, reforms like GST and demonetization has improved tax compliance. It has merged parallel economy into main economy, and this has created more efficient, more organized, more formal economy which will be beneficial. Put all these things together, we do expect 2019-2020 to be a better year from economic point of view. And if we can overcome the hump of election, I think markets will reward investors. From a sectoral point of view, today divergence is quite high. IT looks good, pharma looks good, and FMCG, while looking expensive, could be good, provided we have political uncertainty. In a scenario where election results will be shocker to the market, this kind of defensive sectors will do well. On the other hand, in an election result where stable government returns, then capital goods, real estate, infrastructure, construction, and small cap portfolio will do well. So effectively, it will make sense to play contra at the extreme point. If market is at a very high level, that means it is pricing stable government. Please keep your portfolio in large cap and defensive stocks like IT, pharma, FMCG, because in case there is a shock to the market and we end up getting a coalition government, the stocks will fall much less than the broad market. On the other hand, if market is at much lower level from current level, it's pricing in a coalition government, then it's time to invest in small cap, capital goods, infrastructure sector, because in case market gets a surprise result, these sectors will bounce back much more than the broader market. It's time to play contra if you are playing for May 2019 election. If you are a long-term investor and you can invest for a longer term, then please continue doing your systematic investment plan, and please also follow a disciplined asset allocation which allows you to allocate between debt, equity, real estate, commodity, and currency so that your portfolio remains reasonably diversified. One final thing on the opportunity for India, it's courtesy the US-China tariff war. China has been generating almost $325 billion of trade surplus with US, and they are doing it every year. Our total export is not $300 billion, and China's trade surplus with US alone is exceeding that. This has pushed President Trump to impose tariffs on Chinese exports into America. Right now, on some of the items, tariffs are at 10%. On 1st April, if there is no deal between US and China, tariffs will escalate to 25% across most of the product. This imposition of tariff has pushed manufacturers out of China into other countries. One of the economist report mentioned footwear going to Cambodia, computers going to Taiwan, electronics going to Thailand and Malaysia, food processing going to Vietnam, and clothing going into Bangladesh. It didn't talk about anything which is coming to India. This manufacturers supply goods or export goods. Companies like Amazon and Walmart, both of them are present in India. Amazon will never be allowed to enter China, and in fact, they'll be worried if Alibaba their comes into their domain in US. Walmart does not have one shop in China. Here we have allowed them to invest into Flipkart and take over the company. To approach Amazon, Walmart kind of large buyers of Chinese goods in US who can influence their suppliers to shift their manufacturing base from China into India. We do make footwear, we do make clothing, we do make food processing, we do make electronics, we do make basic computers. And we are making it on a much larger scale than many of the countries where these manufacturers are moving on. If we can create a well crafted strategy whereby Chinese manufacturers move out of China into India and start using India to export these goods to US, then to that extent our manufacturing base develops. We did this with Y2K in the IT industry. Our IT industry grabbed the opportunity by developing solutions for Y2K, and thereafter we have created giant companies. Entrepreneurs like Narayan Murthy, Shiv Nadar, Azim Premji, they all created giant Indian IT industry. And that was created based on the small opportunity provided in Y2K. What Y2K did with India's IT industry, similar thing is possible with India's manufacturing industry by capturing opportunities unleashed by the US China tariff war. This is as good and as big as it can get, and that will provide us huge opportunity to take our growth into double digit. If I have to summarize, this budget has been pragmatic. It has met political compulsions of an election bound government. At the same time, it has given boost to consumption to accelerate growth in an economy on a more inclusive basis. And while meeting these conflicting objectives, fiscal discipline has been maintained. This will enable investors to maintain their confidence on India. This budget will push consumer related growth in rural India as well as urban India. Rural India will get boost as farmers have been provided universal basic income. Urban India will get boost as middle class taxpayers have been provided tax rebates. Combination of this will result into better growth in the days to come, and a stable government post election will continue to accelerate growth in the days to come. There is a great opportunity for emanating from US China tariff war. It's as good as Y2K opportunity for Indian IT industry. Let's hope and pray that we capture that opportunity. Then our GDP growth could go into double digit. For debt market post budget, they'll be looking forward for direction from RBI. Either it could be a policy rate cut or it could be guidance towards lower interest rates in the days to come if inflation trajectory is maintained. For equity, they will be looking at Jan to March quarter business momentum, and of course, they will be looking at the election results, and that will determine how equity market behaves in rest of 2019. As an investor, will recommend you to keep this broad macro perspective in mind. In equity, try if you are playing for May 2019 election, then try to play contra. At higher level of market, be defensive. Invest in IT, pharma, FMCG, and large cap kind of defensive stocks. At lower level of market, take risk in small cap, consumer capital goods, infrastructure, and real estate. If you are a long-term investor, then continue doing your SIP and follow your asset allocation. In the fixed income space, we'll recommend you to take dynamic bond funds which play on the duration side of the market, or you can look at credit risk fund where the current coupon income are almost in double digits, lower double digits. So this is broadly how we see the market, and we wish you a very pleasant, happy investment experience. 2018 was not that pleasant, but if you overcome the hump of elections, then my guess is that with stable government, 2019 will compensate for 2018. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.